You likely know where we are right now. We're in the U.S. Bank Lounge at Money 2020 in Las Vegas. I'm Steve Johnson. I've been hosting the series, The Future of Finance. And today we're talking the tokenized future of banking. With us are three folks. We have Mike Villano. He's a Senior Vice President of Enterprise Innovation at U.S. Bank. Next to him, we have Kirill Gertman, CEO of Conduit. And next to me, Stephanie Perez. She's the principal with Fin Capital. So thank you very much for joining us as we explore this idea of stablecoin and everything that surrounds it. But a lot of it surrounding this really has to do with the idea of partnerships, collaboration, how everyone's working together. And Stephanie, I want to start with you first. What are misconceptions that people might have about fintech, that banks have about fintech, that fintechs have about banks when it comes to stablecoin?
Yeah, for sure. Mike, you and I have had this conversation, but in terms of what we're seeing as it relates to volumes, how much of that can actually be accredited to hedging or perhaps B2B flows. And I think that what we're seeing in the market today, I think especially in this new administration this past year, is the fact that there's an increasing volume that's actually going towards more B2B use cases. And there are multiple different reports citing up to 113% jump since February. So I think that's a potential misconception that many fintechs are helping address. And then on the other side of the spectrum, and this doesn't just apply to stablecoin or digital asset companies, I think it's across the board for all fintech companies, the notion that banks move very slowly. But the reason in which they do so is because first, they have to make the actual business case for why this is something that they should be investing in. And generally the way that budgeting cycles work for banks is that they have to think about whether this is something that keeps the lights on, whether it's something that makes them defensible and is accretive in some manner, or whether it's something that's really, preserving the bank in the long term, right? 10, 15 years from now. And I think banks are still kind of thinking about what exactly that means for their strategic mandates.
Is that something that, it's good for a bank to be a bit more nimble, a bit more okay with taking some initial risks, even in some ways? Is that a piece of this or no?
We always classify it as responsible innovation. And we've said before, innovation is good, responsible innovation is best. So we have to take calculated understanding of the business and the risk, the inherent risks of that business, and the way we need to mitigate that risk. To Stephanie's point about banks moving slowly, there's an aspect of a mindset of banks have technology debt. And that exists, but that technology debt, the value of it is resiliency. Technology infrastructure is very resilient. It runs the U.S. economy, or it runs the world's global economy, and the world has come to rely on that. So it is resilient, but fintechs move very quickly. And when it comes to adopting a new technology and having an opportunity to build it on top of new technology, companies like Conduit make that happen. And companies like Fin Capital, from where Stephanie's from, they allow early insight into those companies and the way they're driving the market and what they're bringing to market. And that gives us early access to what those value propositions could potentially be and how it materializes for our customers.
Hey, Kirill, from your perspective on all of this, what are you looking for from banks, from VCs, and able to get that scale going and have a good collaborative experience?
Yeah. So I think these are really two separate questions, actually, right? So what we look for from VCs is the C, which is the capital, right? How we're gonna create new products, how we're gonna build. We obviously need capital, and that means somebody who can understand our vision, believe in our thesis, and give us capital to execute on that. So that's the VC side of the things. In terms of our relationships with banks, and I think we have about 30 banking partners around the world, 5 or 6 now in the United States. We're building a brand new system, a brand new rail in which money moves and value can be stored. But that without a connective tissue to the actual existing rail, right, to the existing fiat world, what we're building is extremely difficult or impossible to access, right? So what we're looking for a banking partner is a little bit of similarity in the sense that, like, what we're looking from our venture capital is understanding is what we're trying to build. However, from banks, we're not looking for capital, right? What we're looking for banks is essentially a partnership. Can we build together? And within that partnership of building together, I think what's really important is for us to understand the bank's appetite, like how far does the bank want to go? That means both in the sense of technology, in terms of compliance, in terms of what the bank has to report back to the regulator, And how far are they looking for us to go with them, right? So like, what do we need to provide in terms of tooling, in terms of technology, in terms of reporting on what we're doing? That's what we're looking for from a banking side.
How would you look at this, Mike, then, in terms of the collaboration of these three pieces? Is there anything else that you need to add into that to make that collaboration optimized?
It really comes back to having a very focused use case with a good idea and an excellent idea of who your end customer is going to be, and then a way you can deliver that safely. And relying on the technology build of fintechs allows you to move the technology stack along that, but there's all the operational elements to delivering a product to market that have to be in place as it relates to U.S. Bank delivering something to end customer. So the only add there would be it's taking the business model that I think is working well for the fintech and thinking about how we can help with distributing that to our own client base.
Yep. One of the things, Kirill, that we've talked about is seamlessness. We're talking about it in a couple different places. What infrastructure do you see that is actually needed to make stablecoins interoperable, to really make it interoperable with existing payment rails?
Yeah. So I think for me to be able to answer this in a way that makes sense, first probably ideal to understand what stablecoins are good at and what they're not good at, where they're being used today and where they're not being used today. So where stablecoins, I would say, shine today is in money movement, in connect, especially across borders, right? So if you're sending money from the United States to Mexico or to Brazil or to China, wherever that may be, the part where stablecoins really provide an advantage over existing systems is the in-between, right? So like from the US to China, right? It means the advantage being it's faster, it's cheaper. However, in order for you to get the stablecoin in the first place, you need the ability to convert from your local currency, dollars in my example, and similarly on the other side, right? So you need the ability to convert it out into the other local currency, right? Because if I am able to send a stablecoin from here to Hong Kong, the recipient not necessarily can use that stablecoin in a practical way in their daily life as if they're a consumer, or in their daily business operations if they're an actual business. In other words, they probably cannot pay their rent in a stablecoin. They probably, if they're a business, they probably are not paying their employees in a stablecoin, right? And so where that comes in is that connectivity between the local currencies, so dollars in this case, maybe HKD or CNY or other currencies, but the method of transfer is changing, right? So this is where stablecoins really shine, is being a much faster way to transfer the value from one point to another.
How do you then, from a banking side, how do you prepare for the impact of stablecoins, of these kinds of coins, into the traditional framework?
We have continued to view blockchain and stablecoins as an alternative payment rail. If it proves out to be more efficient, less costly, faster, as Kirill is outlining the case for, it's an opportunity to move money cross-border specifically faster. And there could be elements of it has to go back to fiat if you need to pay your rent, as you gave an example of, or your mortgage or such, that it goes back to fiat for the last mile aspect of it. So it's the preparation that what is the specifics of the use case, and at this point, a lot of the focus has been on the cross-border element of it and understanding of how do you off-ramp that. At some point, it goes back to fiat, like Kirill was saying. And, well, the good news is banks are in the business of fiat. You've been in that business since the beginning. So at some point, the stablecoin converts back to that, and now you're back to your traditional rails to move money. But you can look for the inefficiencies in the way things are today to potentially build out some better payment networks.
And are there any? Oh, go ahead.
No, that's exactly how we work with banks today, right? So with all our banking partners, the main reason for us to get to partner with 30-some banks across the world is exactly that piece of how do you actually convert this into something that you can use every day, right? You're not going to pay your Starbucks coffee with a stablecoin, at least not yet. Maybe that's going to happen in the future. But for now, you need cash or you need a credit card, right? So that means you need an issue bank, you need a bank account that's attached to that. Without it, there's just not enough utility unless you're in a crypto trading type use case, which is not what we're supporting.
Will the use of stablecoin make the Starbucks line go faster? That's probably the next question we're all going to have.
Probably not.
When it comes, Stephanie, to the Visa, to the investment side, stablecoin projects. Well, what are the lenses you're using to be able to say, yeah, this is viable. Yeah, this has long-term potential.
Yeah. So we're B2B fintech investors, right? And so we're always taking the lens of the enterprise. What would the enterprise, be it a bank, an asset manager, an exchange, be utilizing stablecoins for, right? And I would say as we look at the companies that we've invested in this space, there are a couple of things that have been a big focus. The first is regulatory engagement. And that's actually one of the things that I commend the Circle team on. They've spent quite a lot of time educating regulators in DC. And there are actually many of these companies that are actually going out and getting bank charters and licenses. That's a lot more regulatory oversight than they have today. But the notion behind it is that they'll be able to launch products a lot faster than they have today because they'll have a lot more regulatory certainty. And so that's one thing that's quite important. Second, folks that are investing in compliance early on. And so whether that's hiring the proper folks internally, building out the proper processes through third-party partners. The third is folks that have an understanding of the way the current system works today. It's very difficult to go up to someone like yourself at a bank that has massive flows in terms of treasury and payments and the like, and to tell them that you're going to disintermediate them, right? And so how do you work within the current construct of the technology limitations that a bank has? And then lastly, I would say it's focus. It's quite applicable to numerous other use cases, and this is actually something I commend you guys for, being highly focused on certain corridors, certain use cases, cross-border being the forefront, and whether that be AP or payroll, being highly focused. And that's something that actually applies to any startup, right? You need to be able to find that early problem market fit, product market fit, especially in a world where there are so many naysayers. So,
is there any way for you to predict where you think that regulatory elements are going to be? Or how they're going to,
we live in interesting times. You know what I mean? This administration may be very different, but for now, it seems like it's obviously a very crypto friendly administration. And so we'll see. There's also market infrastructure regulation that should be expected to come soon, and that'll be quite relevant for all things tokenization too, outside of just payments. So I think it's kind of evolving.
And I think that kind of gets to one of the things, Kirill, I want you to talk to inform us on the education and trust. I mean, if we don't even know exactly where or how the guardrails are going to look or how this is going to be interoperable and some of those things, there's still a lot of question marks for a lot of people. How do you build the trust? How do you use education as an opportunity to get people to participate?
Yeah. So I think there's a couple of aspects to that. And number one is actually we usually start with the benefits. Like, why should you even care about this in the first place? And usually that means, again, faster, cheaper, more reliable payments, right? Because in order to educate somebody, at the very least, you have to get their curiosity, right? You have to get them a little bit engaged. And for them to be at least, somewhat curious, at least engaged, you have to outline first, like, what's the benefit that they will get? So we usually start with there. The next set of questions is, okay, how does it actually work? And what are the risks, right? And what happens if things don't go as they should? And so then we go into explaining how Circle, for example, functions, right? We don't issue stablecoins ourselves. We work with existing issuers such as Circle. And so we have great visibility into, for example, the underlying assets that are back in USDC. We have the audit reports. Circle now is a public company. So there's a lot of information that we can bring and we can demonstrate exactly how this process works, why USDC in particular is 1-to-1 to the dollar, why that's not going to be changing anytime soon. Things like that, right? And then number 3, compliance. So as Stephanie alluded to, all the processes that we adhere to, whether that's KYB, KYC, ML, DSA, etc., we are doing this in real time, and we can demonstrate this. We can show exactly how we do this. We can show the report that we get. We can show how we do sanction screening on stablecoin wallets, for example, and things like that, right? So it's just demonstrate. The proof is in the pudding in that sense, right? And then finally, we can also demonstrate to our customers and to our partners, what are the fallbacks? What happens if there's an error, if there's a mistake, somebody keyed, the wrong address or whatever that may be. And we have ways to essentially avoid that and mitigate that as well. And we can demonstrate that. And so then we kind of come around full circle and we say, all right, now that you've seen how this works under the hood, so to speak, that we showed you everything that we're doing to make sure that it's compliant, that it's safe, that it's secure, let's go back to the benefits. And we can actually, again, demonstrate, usually live, of the cost advantage and the speed advantage of using a stablecoin versus using traditional rails.
How much time from each of your perspectives needs to be put into contingency? Needs to be put into if things go sideways or things don't pan out the way that you want it to?
A lot. Like Mike was saying, like, these systems need to be resilient. They need to be reliable. We're moving people's money, right? We're touching people's funds. We're moving people's money. And if there are any issues that is extremely uncomfortable for any, of our customers, for any of our partners, I would actually argue that stablecoins are better at this in some ways than traditional rails. And so if you're sending a SWIFT transfer, as I'm sure you know very well, usually that goes through a network of correspondent banks. And there's a hop, right? So you go from one bank to another bank to another bank. Sometimes, you can have up to 3, 4, 5, 6 hops. Each hop introduces the possibility of error, possibility of mistake, whether manual mistake or, bugs in the system or whatnot. In order for you to then trace your funds, you're going to request what's called an MT-103, which you guys know very well what that is. And that will tell you where your money was yesterday.
So from your perspective, from a unique out of this group perspective, is this a threat? Is it complementary? Is it completely disassociated and just a new way of doing the same business?
If I could just build on for a second what Stephanie and Kirill were saying, then I'll jump into that because it's a great question. But there's no room for a reduction in consumer experience or a reduction in consumer protection. And what's great about working with companies like FinCapital, VC, and talking with Kirill for Conduit is their willingness to share their experience and their expertise. It goes a long way, and I think education is one of the things they do really well, and I think it's underappreciated how willing they are to share that. Now, to come to stablecoins as a threat or a complement, I think we view it as an alternate payment rail. We think that it's a complement that can have specific use cases and utility, particularly as it is today when it comes to cross-border. There's potential for longer-term upside where you start to get into things like agentic payments and whether or not agentic payments, and Stephanie and I have talked a little bit about this, but when you look at some of the stablecoin numbers today, you'll see about $10 trillion worth of transactions. And a lot of those are crypto trading or they're done by bots. So organically, there's potentially an overlap with AI leveraging as an organic payment mechanism. So if we continue to see advancement of agentic AI, we might continue to see the advancement of acceleration in stablecoins. And we see that as a complement because customers will want that and we want to deliver that experience to customers.
Use is a big piece of this. You mentioned a little bit earlier about cross-border usage. How are they actually being used in that particular arena? And are they solving problems that banks haven't figured out already?
So actually, this is a recent announcement because it came out last week, and I think US Bank is involved, but with Zelle, actually. So Zelle has the distribution unlock, right? It's like 100 million verified accounts. Today, for the most part, remittances is a low margin, high cost, high friction business for the likes of US Bank, JP Morgan, and the like. And so that's why they often send you off to a MoneyGram or any of these other remittance companies. It's not necessarily a business they wanted to take on themselves. And so that's why folks like PayPal and Wise have been able to win a lot of market share. This unlocks that, right? And it does so in a verified, trusted, massive distribution network. Now, what still exists is fraud and AML and all these other checks that need to occur, and the last mile, which is where folks like you guys come in, because at the end of the day, even if you're I'm Dominican, if I send money to my family in the Dominican Republic, for the most part, they're not going to be able to actually transact in that, right? And so they're going to need to actually be able to do the off-ramping into the local currency to be able to go to the supermarket or to pay their rent, right? But nonetheless, I do think that they solve for the distribution, which is always kind of key in terms of adoption.
So many elements going back to the education piece about this still, even people in the business still learning about this, how it's going to roll out, how it's going to really play. So in this arena, there are probably fewer skeptics than in others. How would you explain to a skeptic, yeah, this is going to be something you want to get involved in? What would be a sentence to help change their mind or at least change the consideration set? Can you start with us?
Oh, I'm an optimistic, right? I'm always looking to fund the next thing, so I'm always going to hope. But
come on, join me.
No, but certainly I think it's efficiency, right? And efficiency means different things to different people. For some people, it's cheaper. For some people, it's faster. For some people, it's access, right? But I think overall, efficiency is what we're trying to solve for.
Okay. How about you?
That's exactly right, actually. So essentially, we go back to the value proposition. It's faster, it's cheaper, and it's more reliable. And then how does it work? That's a secondary question to most people. It's what are the benefits that we gain? And usually being able to see the benefit converts most skeptics.
It's a great question. And it's, if you believe all payment are solved, 100% efficient, and there's no room for improvement, then okay, don't look at stablecoins. But it's tough to think that when we're at a conference like Money 2020 and everybody's here talking about how to improve payments. Well, stablecoin should definitely be part of that conversation. So,
Stephanie Perez, Kirill Gertman, Mike Villano, thank you very much. Always insightful, something very important for this particular meeting. Thanks for joining us.
Thank you.
All right. We're going to always be back for more. Keep your eyes open for what's going on here from the US Bank Lounge at Money 2020.